Hello and welcome to another episode of the Sunday segment, a place where I break down the three biggest financial news stories of the week. This week we're going to talk about the Fed paving the way for a new low rate era, the surge in new tech IPOs, and Saleforce hitting all-time highs, what this means for your money, and what we should be looking out for in the future. So let's get going with the video. As always, don't forget to hit that like button and hit that subscribe button so you don't miss out on any further episodes of the Sunday segment and my midweek videos. This week, Federal Reserve Chairman Jerome Powell announced that the Federal Reserve, the central bank in the US, is going to change its guidance to aim for an average of 2% inflation a year. This is actually a really big story and affects everyone's money around the world for the long term. So first of all, let's clear up what a central bank is. So the Federal Reserve is a central bank in the US, which is the same as the Bank of England in the UK. These guys set the interest rate and they print money. Central banks have been in the news an awful lot recently because they've been supporting businesses. They've been printing more money and reducing the interest rates on loans, which means that businesses have more money to spend. This is so that more people keep jobs and it keeps the economy moving. As a result of more money in the financial system, it means that the likes of banks and financial institutions have more money to spend. Because they have more money to spend, they can afford to spend higher amounts of money to buy financial assets. As we've seen with the stock market hitting all-time highs, this money has to go somewhere, as investors need to find somewhere to actually invest this money. So the change in wording from the Federal Reserve was that they're aiming for an average of 2% inflation. Previously, they'd been aiming for a maximum of 2% inflation. Inflation is a silent killer of your money. Ever noticed how things from your childhood are nowadays far more expensive? This is generally because of inflation. So every time that you've bought something this year, in a year's time, because of inflation, it will get more expensive. To put it simply, if inflation is 2%, the goods that you can buy today for £100 will cost you £102 in a year's time. This is why I always say that putting money into your savings account is not a very good idea. Because at the moment, interest rates are so low, lower than 1%, that if inflation stays at the aim of 2%, you're losing the purchasing power on that money every single year. The best way to benefit from the growth of inflation is to be invested in financial assets. However, inflation isn't always bad. Inflation is needed to keep the economy growing. If the inflation is at 2%, that means that costs and goods and hopefully wages grow around 2% per year, meaning that everyone in the economy gets richer. Why is this important? Well, since the financial crisis in 2008, central banks have been keeping interest rates at all-time low. This is because when interest rates are so low, it encourages the economy to keep going and keeps people spending money. And in theory, when people spend money, inflation starts growing. And as inflation starts growing, then central banks will intervene and raise the interest rates just so that inflation doesn't get too out of hand and that £100 that you have today is essentially worthless as the goods in the future cost something crazy like £200, which is good for nobody. However, the big problem here is that the economy hasn't been growing at 2% per year and inflation hasn't actually hit 2% per year for the last decade or so. In actual fact, it's only hit around about 1.4%. So the Federal Reserve's wording the other day means that inflation can get out of hand. It can grow more than 2% as long as the economy is growing. They don't mind it expanding a little bit too quickly, and if it does, it will start reining it in using other tools like raising interest rates. But at the moment, it's really focusing on growth. But to put it this way, it means that interest rates aren't going up anytime soon. By interest rates not going up, it means that there's more money in the financial system, which means that the price of financial assets like stocks and bonds will just keep going higher and higher. This also means because the interest rate is so low, you're not gaining any money from that money sitting in a savings account. And also, as inflation is probably going to be higher than the amount of interest that you're receiving off a savings account, it means that that amount of money is technically losing its purchase power as it moves into the future. This is why I always say invest your money. Keep a small amount of money in an emergency fund, but the rest of your money invest into financial assets, putting it into bonds, stocks, and real estate. Just think that central banks are trying to encourage the economy, and the way to benefit from the growth in the economy is to invest in companies and real estate that will benefit from businesses growing and the economy growing. So moving on from central banks printing more money, go straight into a surge of tech IPOs. Stock markets around the world, and particularly in the US, have hit all-time highs, and this has been particularly fueled by the tech sector. As I mentioned earlier, this is partly because investors don't know where to put their money right now. So they're looking for investments, and the tech sector is absolutely booming. We've seen this as shares in Apple, Microsoft, Amazon, Alphabet, Tesla have hit all-time highs, as investors don't want to miss out on this tech surge, as the coronavirus has really affected so many businesses. However, the tech sector has been particularly resilient. Right now, as the stock market is hitting all-time highs and the tech sector is right in the focus of all investors and is looking quite hot at the moment, tech companies are looking to take advantage of this and list onto the public markets. When they list, it means that previous investors are selling out. This could be the owners or other investors who have just invested their money earlier in the company who want to cash out. And also by being public, it means that individuals such as myself can invest into these companies irrespective of where I live around the world. Two of the most anticipated tech companies that are planning on listing right now are called Snowflake and Palantir. Snowflake is a data warehousing company that focuses on cloud computing. And Palantir is owned partly by Peter Thiel, the founder of PayPal, and is a secretive company that provides data and services to the military and governments. Both of these companies aren't providing any sort of profit, however they are growing, but both at different rates. Snowflake, which is touted to be valued around 20 billion, which is more than Airbnb at 18 billion, just lost 172 million this year alone. Palantir, on the other hand, has been around for 17 years and has never turned a profit. Last year alone, it lost $600 million. Despite being loss-making, both of these companies want to take advantage of the world and the scenario that tech companies are in right now. This year alone, 18 tech companies have listed for an aggregate value of $5.5 billion. And impressively, these stocks have generated over triple-digit returns, which is massively impressive. Part of this can be down to central bank intervention and the fact that investors don't know where to put their money, so they're looking at anything which is growing. And these tech companies, particularly Snowflake in this example, is growing massively year on year. So when these companies list, it will really be a test of the market to see investors' appetite for tech companies. Snowflake is expected to perform well when it hits the market, as it has impressive growth year on year and a niche product. Palantir, on the other hand, is an almost 2-decade-old company which has yet to hit a profit. Palantir hasn't really grown year on year and has really just been a loss-making company where the current investors have just been sinking more and more money in. It looks as if those investors want to cut their losses right now, sell the company to the public and recoup some of their money. If this stock does perform really well at IPO, then we may be moving into a tech bubble territory, similar to what we had in the late 90s. Unfortunately, at that time, an awful lot of companies went bust. I'm not saying that will happen now, but it's definitely something to watch out for. And as always, do your research when looking into a company and research its fundamentals. If, on a value sense, it doesn't make sense, then I would say just don't invest. Don't get caught up in all the hype and don't get caught up in becoming the next tech billionaire. Just really focus on understanding the fundamentals of any investment before you invest. And finally, we're going to look into an established software company which has posted impressive price growth this week. This week, Saleforce share price jumped 27%. That is massively impressive for a well-established, big software company that is used around the globe. Salesforce is a customer relationship manager, which means that it enables companies and individuals to track their customers. So anytime that you've called up, say your bank, and you've spoken to different individuals, however, they've been able to track your previous phone calls and what you said to different people in their team, that is all done through a piece of software called a customer relationship manager, very similar to Salesforce. And right before the pandemic, the share price of Salesforce dropped dramatically because it was exposed to the airlines and leisure sector. However, on Wednesday, Salesforce posted really impressive results, meaning that share price jumped 27%, adding $50 billion to the value of the company. In this scenario, two things happened. The stock was oversold by the market, pushing the share price down. This is because the market was expecting the worst. Because of the lockdown, travel and leisure industry was being hit extremely hard. And as these were the main clients of Salesforce, the stock got pushed lower with the expectation of lower profits. Even the company said they were expecting lower profits. Fortunately, the company pivoted and has started new business segments and produced high levels of profit. It has also provided good high-level guidance for future profit for the rest of the year. As well as the high profits and the ongoing strong performance predicted this year, Saleforce was added to the Dow Jones Industrial Average Stock Exchange. The Dow Jones is a stock exchange which holds the 30 largest companies in the US. This has massively helped the Salesforce stock price, as there are exchange-traded funds which track just the 30 companies that are in the Dow Jones Industrial Average. This means that every individual who owns a share of an ETF that tracks the Dow Jones will now be buying a share or a couple of shares of Salesforce stock. This really highlights how markets can be irrational. Sometimes they can oversell a stock, pushing the share price down too low, and then flip around when they hear positive news and then push the share price too high. A 27% return in a day is massively impressive and extremely rare. However, this just shows that it's a great time to buy a stock when other people are selling and they think that actually it's not going to be performing that well in the short term, because often this pushes it down by too much, creating a bargain. When a stock is oversold, it really helps to be able to buy that stock if you believe in it and understand the fundamentals, as you're getting a bargain price. And then you can benefit from a surge of 20%, which, whilst extremely rare, can happen in the stock market. I hope you've enjoyed the video and hope you found the stories interesting. If there's been any more stories that you found particularly interesting, let me know in the comment section below. And as always, before you leave, make sure you hit that like button and hit that subscribe button, and I'll see you next time.